Okay, great. Hello, and thank you everyone for joining us for our next virtual discussion put together by iGlobal Live. Today, we have put together a conversation on capitalize on the rise in demand for single-family rental homes. My name is Marina Dukas, and first and foremost, we hope that everyone is staying safe and healthy during these unusual times. Our core mission has always been to develop connections and deliver industry content between like-minded individuals. And for now, we have reinvented the way to facilitate this for our community through these online discussions. So what we have here for you today, I am joined by a panel of thought leaders who are going to speak from their own point of view regarding the future of the industry. A couple of housekeeping notes for our viewers before we turn to our panel. All viewers are now on mute, and in the footer, if you move your mouse, you will see a Q&A dialog box. Please feel free to submit your questions anytime during the panel. Also, towards the end of the discussion, we'll have a live poll. We will prompt you to select which speakers you would like to be personally introduced to, and we will then connect you via email after the event. So without further ado, I would like to introduce and welcome our panel and the moderator, Jordan Cavana, CEO at Transcendent Investment Management. Jordan, off to you.
Thank you, Marina. I appreciate the introduction and welcome everyone who's dialed in. I want to also thank my esteemed panelists for joining me on this panel and allowing me to moderate today. So a quick word on myself and my firm. I started Transcendent Investment Management in 2008 at the kind of global financial crisis. We were initially buying, repositioning, and selling single-family homes in 15 markets across the U.S. We then, in 2013, became long-term investors and owners and operators under a company called Build US Back throughout the Sun Belt plus Texas. Last year, we joined forces with a large multifamily owner and operator. We are now a 40,000 unit strong firm. And we also are partially owned by an offshore public company as well. We are 65% in the build for rent space and 35% in scattered SFR in the Sun Belt plus Texas. And our investment plan over the next 3 to 4 years is to deploy somewhere around 3 to 3.5 billion in capital. With that said, I just want to give my fellow panelists the opportunity to introduce themselves, and then we'll dive into the presentation. Dan, would you like to start?
Sure, thanks, Jordan. I'm Dan Magder. I'm the founder and managing partner of Center Creek Capital. We're a single-family rental group that focus on workforce or affordable single-family rental. So that we started, I guess, in around 2015. We are currently raising our Fund 3. Our Fund 2 is now fully invested. We have a couple hundred units across Southeast United States. We think that's a good market. We can talk a little bit about that a little later. One of the things about Center Creek is we have an explicit focus on affordable housing and serving low, moderate income residents, both providing them with quality, affordable living opportunities, but then also layering on social services and resident services that promote racial equity and economic inclusion. So that's the SFR part of our business. We also have a single-family construction, infill construction group called Center Creek Homes, and we are building homes ground up but we have about 50 projects going on right now in that space as well.
Wonderful, Dan. Thank you. I also failed to mention, I apologize. I am traveling, unfortunately, and I could not get my camera to work on my iPad, so forgive the audience that I can't be present on camera. Matthew, do you mind going next? You're on mute, Matt. Still on mute. Oh, there you go.
Thanks for having me. Glad to be here. Excited about the conversation we can share today. My name is Matthew Abrahami, and I work with a firm called Harvard Investments. I joined Harvard Investments a few years ago to acquire target sites and carve out existing land holdings within their master plan community development business so that we could launch a portfolio of purpose-built communities with single-family homes for rent. And we've grown since then from about 200 units with our first project to right around 2,000 units across 9 projects today. I also have a background in debt equity development, distressed assets, and opportunistic assets with institutional capital. And I'm active in the community with teaching at the local university and ULI locally and nationally. So thanks for having me, and I look forward to the conversation.
Thank you. Thibault?
Hi, everybody. Thanks, Jordan, for the introduction. So my name is Thibault Adrian. I'm the founder of Lafayette. I created Lafayette back in 2011. Today, it's a private equity fund, vertically integrated. We own a property management company. And we are also in the lending space. We lend to fix and flip investors. And so today we have about 3,000 units, SFR units under management that we own and operate. That's about 700 million of total gross assets under management. And we got into the BFR space as well back in 2019. We are very excited about the space. And we are now getting into the land acquisition space as well, because we feel that we must have this skill set in-house if we want to keep growing. So that's about us.
Thank you. Peter?
Hi, my name is Peter Burns. You can read it right. I'm actually from the United Kingdom. I work for a business called CBRE. I think there's a few of us over in the States as well. My role in the UK is to lead the residential capital markets business, and that is buying and selling institutional grade residential. We cover the whole spectrum from student all the way through to senior, but most of our time is spent in what we call build to rent, and within build to rent, multifamily and single family housing. And I'm sure we're going to trip each other up to date with what we call everything. I've already had that with Matthew. And what we've seen recently is that the single family housing market is beginning to really take hold in the UK. And I think that's what we're going to talk about later. It's a trend that we think is going to continue for all the good reasons that everybody here is going to talk about. Back to you, Jordan.
I'm sorry, I was on mute. Okay, great. So I'd love to kick this off with one question for the panelists that I think is on everyone's mind. We've all seen the influx of capital coming into the space, which of course is leading to some compression on yields. And generally speaking, it seems that the capital is divvied up between passive allocators of capital to platforms, and then of course vertically integrated platforms like most of us on the panel. I'd love to hear in no particular order what your thoughts are on what that capital is going to do in terms of yields, number one, and secondly, while the demographic story for build for rent is extremely strong, and of course that's why we're all in the space, do we think that because there's such an abundance of capital that perhaps we're going to get to a point where there's too much product in the market, and of course it changes the economics?
I can go ahead. Our experience, clearly we've seen the cap rates going down in the last year or so. They've been going down gradually since 2011 or since I've been in this space, but there has been a shift really in the last year or so where we have seen some of our capital partners moving their investments from their opportunistic funds to their core plus funds. So that's a clear change. I think a clear reduction in target returns from some of those funds who were initially like targeting high teens returns and were now down to low teens returns. So there has been a shift for sure, but that shift I think happened for a reason. And it's also because the risk part of the equation has also improved tremendously. The operating margins have improved. The financing, debt financing market has improved a lot. And the track record of most of us as operators has improved a lot in the last few years. So, and finally, the picture on the demographic side is even clearer post-COVID than pre-COVID. So I think for those reasons, there has been a shift for sure, but I let everybody talk about why we still like feel comfortable about it. But I have some thoughts, but I want everybody to chime in.
I jump in and I'd say I agree, Thibault, that you know, the money pouring in means yields are going to be getting compressed. But you're right, expectations are going down a little bit. I think you sort of touched upon it. You know, whatever it was 10 years ago when we all started thinking about doing this, if you talked about an institutional approach to single family rentals, people thought you had two heads. I mean, just look at you like you're completely crazy. And I think that for years, I think, you know, many of us here have been pounding the table and saying institutionally managed single family rental is actually a form of multifamily, and it is an institutional asset class. It's taken a little while, but I think the investment community is actually starting to recognize that. So there, I think, you know, you're right about the expectations coming down. Debt has definitely gotten better. That has certainly helped. I think that, you know, if you look at housing starts over the last 10 years, we're down, the recent statistics I saw were down 45% in terms of new homes being built over the last period of 10 years before that. So there is such a supply-demand mismatch in housing. I think all of us could build almost as much build for rent as we'd like, and there'd still be an inordinate demand on the, you know, renter side for housing. So I think you have that. And then I would also just say that, you know, for us, there's a huge role, not just in build for rent, but in the scattered site that you do, Jordan, that I know Thibault does as well, because we can preserve a house. We can go and buy a house, renovate it, and get into a rental for less money than it costs us to build the house. So particularly for us, looking at workforce housing and affordable, we can build houses, and we do. It's hard for us to build houses and make them affordable. So we actually are building them at a different price point to a different target audience. And for the workforce housing that we're trying to, that we do, that's much more buying older infrastructure. We almost think of it as reclaiming obsolete inventory. This is houses from 1960s, and we're putting in a lot of renovation, taking care of deferred maintenance to put them back into productive use. And we can actually do that at a lower price point. So I think there's a ton of demand and a lot of different ways that we can address it.
You know, I'll kind of add into that. I think, you know, when I look at the data nationally in the U.S., we're short, you know, according to Freddie, 3.8 million housing units. Other studies have similar egregious numbers where, you know, we're substantially short. We have a significant shortfall in housing. And then if we drill down farther, I was reading something last night from the Brookings Institution about how the housing that we're building actually doesn't meet the demand and needs of people today, where, you know, 20 years ago, you know, roughly 3 to 5% of households had unrelated people living together, and today it's 20%. So, you know, that's just one example of how the housing needs are changing demographically, and we're not necessarily delivering the exact supply that meets the need. But, you know, all that being said, you know, to Thibault's point, you know, when this business started, it was still very mom and pop. Technology and supply chain and management systems were being created so that we could realize the efficiencies we're starting to prove out today. And, you know, that's taking risk away from the investment. And what we're seeing increasingly is parity with multifamily, as far as where homes are trading on a cap rate basis. So I think that makes SFR an attractive asset class as a way for funds to diversify away from multifamily, still have exposure in alternatives, and see, maybe some alpha in comparison to how other real estate assets are performing.
Yeah, it's an interesting point, Matthew, because in our markets, we still see a 50 to 75 bip spread between single and multifamily. However, you give some of that back because the operating efficiencies in single family have not yet gotten to the levels of multifamily. And it's precisely for that reason that in our case, at least, we decided to bring a multifamily and single family platform together. But going to the previous question, I think there's also this concern, generally speaking, in the industry of what will happen once the spreads narrow, meaning when multifamily and single family become equal. Do we believe that the robustness of single family rentals is still going to continue because people still prefer more square footage, the horizontal multifamily concept that you get in build for rent? Do we still think that it's going to be as popular, especially in a post-COVID environment? I'd love some commentary on that.
I think it comes down to. Sorry,
go ahead.
Okay, thanks. So I think it comes down to supply, demand, and as Matt said, like there is a 3.8 million shortage of houses in the country, and so as long as you have this shortage, rents are going to continue to be robust. I think the picture is not as clean. On the supply demand picture is not as clean as it is on the single family side. So I think that's why we feel comfortable about it. Those numbers though are national numbers. And I think you have to also be careful on a location by location basis, because those supply demand dynamics could be very different in some specific markets. So I think you have to be, the national picture is very pretty and everybody loves it and everybody wants to invest as much as they want, but as they can. But on a local basis, you still have to be careful and check that supply demand picture market by market, sub-market by sub-market, because there is a big temptation right now to build because everybody says there's a lot of demand. So you could find yourself in a market if there's a lot of land available and the land is not that expensive, and you could find yourself in a market where all of a sudden you have a bit too much supply. So and that was your earlier question, Jordan, about is there a risk of oversupply? I think it takes time to build single family homes, much more than multifamily. But so we have some protection, but on a market by market basis, you probably have to be careful.
Yeah, I love that, Thibault. I think, ultimately real estate is local, right? And it's a huge factor where, so far, I think for the most part, we've seen disciplined underwriting on new development and existing SFR portfolio trades. But, ultimately it's local. People aren't choosing between Michigan and Arizona. They're choosing between Phoenix, Arizona, and maybe Mesa. So, we're looking at market and sub-market supply levels. But, interestingly, for now anyways, I could think of one location in Phoenix Metro MSA where there were 3 built-to-rent projects, roughly 600 units across them. And they all were competing with each other at the same time and leased up rather quickly. So, for now, the demand is super strong. But going back a little deeper on Jordan's question, I think something that the market or the capital is still vetting is the stability of SFR as compared to multifamily or other real estate investment options. And, the data is there, but it takes time for us to really prove that out and buy into it. And what I mean is, when we saw the recession, the GFC, single family rents withstood withstood the recession a lot better than multifamily. And then even this last time, of course, we all know that if you look at single family rents since COVID, they've shown tremendous rent growth nationally, where multifamily has, seen struggles depending on the market. So, I think as the market continues to mature, that starts to remove risk from the unknown, and we'll start to see more parity. So long term, I guess returns come down, but if we're in a low interest rate environment and we have healthy wage and rent growth, maybe there's enough growth overall where our returns are still pretty compelling.
Yeah, I think there were a number of points that everyone's raised that are, I think, really interesting. I was jotting down some notes. I mean, Matthew, you mentioned diversification. I mean, any investor who's listening in on a call, you are almost for sure overweight multifamily and underweight single family. But single family makes up 55% of all rental units in the United States. And I bet most investors do not have 55 of their rental portfolio in single family, because up until recently, you didn't have a lot of institutional ways to get into the single family market. That has changed, right? There are a lot of vertically integrated groups like the ones on the call who are providing institutional investors a way to get in. But simply from a balanced portfolio perspective, you almost need to be buying more single family. I think a couple of things, Jordan, you mentioned the higher cap rates. We're seeing higher cap rates. And you mentioned we give back some of the operating side. That is absolutely true. The other thing that's interesting, though, is we make up some of it, and this gets into your question about product. We make some of it because we have lower turnover, right? So multifamily nationally has like 50% turnover or so a year. Single family is around 35. And what we find is on the affordable side, we're probably closer to 30 or even 25% turnover. Because, and this gets to your question about product, our typical house is 1,500 square feet. I think we're at 3.3 bedrooms right now, 2 bathrooms. And it's, $1,200, $1,300 of rent a month. You can't really get that in multifamily, right? It's more space. It's an extra bedroom usually. Sometimes we have, often we have an eat-in kitchen or a living room or both. Off-street parking, we have a yard. It is a fundamentally different product. And so people see it as their home, not just as a rental. They stay. That is huge. And that was before COVID. Right now you have COVID coming along, and I'm hearing stories about people who said, this is 6 months ago, but even at the lower price points, they don't want to be in an elevator with the other people, right? They didn't want to go to the laundry room and have to do their laundry. They wanted more space. So the movement to single family isn't, just for investment bankers in Manhattan and Silicon Valley guys who are all kind of going out to Tahoe. It's also people in multifamily units who were trying to get a little bit more space for their family. And I think that that's a strong trend that will probably, reinforce the fact that single family is just a very different product and a different experience for people.
Yeah, I mean, those are all great points. Sorry, Peter, I think I cut you off. Go ahead.
No, I was just going to say, from a UK perspective, this is everything that you've seen for the last 10 years, we've seen in the last 2 years. The thing that I chimes for me for everything that's been said, and maybe you can look at the UK as a looking glass for what is happening in other markets, is that occupational resilience has been tremendous. That you were talking about then, Dan. And, if in our multifamily product in the town centres where there is no amenity space that you can use during COVID, there's been quite a flight out of that product. That's quite loose, that's quite fluid. And we've probably had 15% vacancy on some of that product. All the housing stock, which there isn't much of, but the housing stock that there is there has been full. Delinquency has been 0 and turnover has been 0. And I think the landlords were quite surprised by that, and they're just beginning to work out, well, actually, I've got something that's really sticky here. These tenants are going to stay because the school's nearby, you painted your picket fence yourself, you do your own garden, You know, they've got some reason to stay. It's a long-term commitment, and multifamily for different reasons isn't for everybody. So I think that is really interesting. And again, I think the compression on pricing for us has been such that we probably were 200 basis points out on the cap rate. We're probably closer to 100 basis points now. So I think, you know, everything that you're seeing, we're kind of seeing. Location is super important, Thibaut. You know, Matthew, the investors are coming in, they're looking to share around. So it's a very similar story, but it's all concentrated in our place. Our biggest challenge, to your question, Jordan, about supply is we just don't make land like you guys do. It's just such a small, constrained planning environment. And the biggest impediment is the for sale product in the UK is still very strong. And the people who deliver product, that, you know, maybe you guys are going to talk because you're vertically integrated. We don't have that here. It's very hard to build anywhere near as cheaply as a house builder who can buy the bricks and the timber and they've got the supply chain. You just can't do that as an investor. So you have to get on alongside a local developer. Maybe one of you guys are going to come to the UK and we can get some vertical integration, some efficiencies there. But there's a lot of things holding back supply, but demand is going through the roof.
Yeah, well, that makes a lot of sense. And look, fortunately, you have history getting in the way of your production of land, but that's probably a good thing. You know, so I think another point worth discussing is, you know, in our case, we started a preventative health oriented program a couple of years ago, actually a company that we've rolled out to our residents, and now we're rolling out to third-party companies to address, you know, what we call internally as the intel inside. We really want to take care of our residents. We want to make sure that they're healthy long-term and give them a reason to be sticky. So I guess the question is somewhat tied to the supply question. Do we think, excuse me, how important do we think it's going to be to create some real lifestyle components around dispersed housing, because not all of them are in communities, so that this continues to be a value proposition that people appreciate into the future?
A question for you, Jordan.
I'm biased, but I guess maybe just we can comment on different things that we're seeing or hearing that people are doing to set themselves apart aside from location.
You know, I can jump on that a little bit, and I'll tell you. So we kind of backed into resident services a little bit. In our very first fund, you know, we're on fund 3 now, but on our first fund, we're focused on workforce housing. And this nonprofit came to us and said, hey, we've got money from HUD. We could do credit counseling for all your residents for free. And I thought, that's kind of interesting. I'll take it a step further. I will pay every single one of my residents who completes your course, because I think it's a good thing for them. And if it helps me reduce bad debt and improve collections and reduce turnover, that's a good thing for us business-wise also. And we started thinking, I remember you talking about this another time, Jordan, about some of the things you guys are doing. I think it's really exciting. And we started doing resident services as well. And again, we're at an affordable price point, so our services might be a little bit different. We're really targeting the audience. We have a program called Pathway to Home Ownership to help people save money, improve their credit score, and eventually buy the house that they're in. So we actually give them 2 years of financial literacy training and credit repair. We do a savings match. So if they put in $50, we'll give them $100 in a savings account to be used for down payment. And we're trying to set them up to be successful homeowners. Now, there's a huge racial equity component to this because 90% plus of our renters are minorities, Black and Latinx. And we know that owning a house is the best way for them to build wealth over time. So that's tremendous. From a business perspective, it helps us attract a higher quality tenant. They stay longer, they treat the house better. It's really a win-win all around. So we've started to do more and more of this. During COVID, we launched an internet program. I think I was sitting around this time last year thinking, oh my gosh, my kids won't be able to go to school next year. Or there's no school. Wow, at least they have Zoom. And thinking, maybe our residents don't have internet. So we did a program where we actually called up all of our residents and said, if you don't have internet, we're getting you broadband. and we launched that in September in time for school. I think these are good things to do. They are good. They are end up being very, very good for business. And just one thing to Matthew's point about in the recession, single family rents did do well. That is absolutely true. Single family rents did better than multifamily. Affordable single family rents had more stickiness than higher priced rents. So I'd say affordable actually has very, very good downside protection in the slow economies, and actually, a lot of good effects now that we're probably exiting the slow economy.
Yeah, I mean,
That's really.
Matt,
Go ahead, Thibault.
Okay, so yeah, on our side, we have two programs also, like to help tenants for financial training and help them with job applications. That's the need, I think, became like very obvious during COVID, because we did a survey among our tenants, and although the rents continued to get paid because thanks to subsidies, the job situation was very unclear to us, because we don't get an ongoing report of the job situation of our tenants. We just see that the rents are getting paid, but we don't know who is paying us. Was it the government, or was it the jobs that they were having? And so we found out that at the worst of the COVID, 50% of our tenants were either underemployed or unemployed. That was like in July of 2020. And so that's when we had the same ideas, I think, that you had, Dan. I don't know if we had a big impact. It's hard to track, but we are having some. We do some sessions. I mean, somebody in my team takes care of that, and do some sessions to help with job applications and things like that. We use a third party to do that. We provide also additional services in our build for rent communities, but nowhere near what Jordan does. But it's more around the smart homes concept. And then for some of our BFR communities, we also add amenities. So we are less in the affordable space when we get into those communities. The average rents are more in the $1,700, $1,800, $1,900, and we have swimming pools, potentially a gym, and a dog park. So that's what we do.
Yeah, from the Harvard investment side, our intention is purpose-built rental communities. So, it sounds like our target audience, or our demographic, our renter profile, they're basically a renter by choice. They have generally the ability to buy a home if they want to. They just choose not to. They don't want the headache of home ownership, the burden. They're more mobile. Maybe they're focused on their career and they want to be able to move around. Maybe they're boomers and they're downsizing. We're in that renter by choice market. And so recognizing that they have a choice, we feel it's, while at this time, one of the amenities is that substantially we have detached units with private yards. That's kind of the product in a community that we're delivering. That is compelling. We feel long term, as the space matures and new product comes online, we need to build these communities towards the future so that they have the ability to remain competitive. And that comes in with amenities and professional on-site third-party management. So we're currently pretty fond of Greystar. We have other third-party managers that we may use on future projects, but they've been great, and they add a level of service and value that residents want. And then on the community side, we're looking at fitness center, clubhouse, of course, the pool and the barbecue area, the dog park, gated access, smart home technology, creature comforts, features and benefits that people want that add value to their life. So that's kind of how we've been approaching the offering to residents.
I think UK, we're a bit behind. I think we have a garden shed is our amenity, or a driveway. But maybe where I don't know, gentlemen, maybe where we're ahead is a big thing for us is ESG and environmental credentials of the building. It's something that is maybe it's sweeping across the States, I don't know, but it's European and it's UK. And longer term, most institutions who are looking to buy any form of residential, be it single family or multifamily, are absolutely insistent that the building meets very high environmental codes because they're owning it for 10 to 20 years on their investment horizon. So that for us is really key. And I think that as a product, when that comes through the system, will be very attractive to tenants because they know themselves that they're putting something back to the community because it's not costing them more. It's just efficient to build it properly if it's designed that way. So maybe that's a question back to Jordan.
Sorry, I was on mute. So, Peter, I think that a couple things. First of all, I think all of the comments that were brought up are extremely valuable. In our case, we have not figured out financial literacy and savings and so forth. But I think that affordable or not, I think that is extremely valuable. And that's something that should become more mainstream. It's interesting. I think that it's early days for us to know everything that matters for the residents, both short and long term. What I can share with the group, which we discovered during COVID when we started polling a lot of the residents, is that we initially thought that things like savings on groceries and nutritional counseling were going to be the types of things that folks saw the most value in. And surprisingly enough, of our different value offerings, where we had the most adoption is in mental health and in sleep hygiene, which is not necessarily, it is interesting. It's not necessarily a crazy thought, of course, because COVID was extremely stressful at all levels. But even today, where in theory, barring for Delta variants and others, we're on the other side of this. We're still seeing that folks are wanting to spend their dollars on mental health and sleep management. So I guess one way of saying that I'm not so sure that the features that are going to matter in the future are necessarily attached to the real estate or to the community. I think that we're moving into a world where folks have a lot of optionality, and at the end of the day, they want to figure out how to take the most care of themselves. And if a setting or an environment or community can help them do that, they're willing to trade down for some of the other kind of creature comforts. It's like years ago in multifamily, you had a gym and tennis court, it was kind of the norm. Then tennis courts started to disappear and they became basketball courts. And now, people don't no longer lease if you have a gym because they're doing so many things at home and they have so much optionality around that. So I think it's an evolving thing, Peter, just to give you a long answer there. Sorry, Thibault, go ahead.
Yeah, thanks. Can I ask a question to Peter too? I mean, I've heard about the big focus from European institutions for ESG and the durability of the product. Will they care as much if they were to invest in the US? Is that going to be also a focus for them? Do they care as much as the US environment than they care about the European environments?
I think they do because it's core to their values. So if you're a Dutch fund manager, your money, it's got to be right wherever it goes in any jurisdiction. So I think it will certainly feed through if it's institutional money from Holland. Anywhere they invest, they'll go for it. And we've had it here. They just won't invest unless they're comfortable that it's got the right credentials, whatever the deal is. And again, it just means you've got more avenues, I guess, in the future.
Yeah, I think ESG is such an interesting question, right? So we decided when we raised Fund 2 to make it explicitly a social impact fund. And we created a social impact advisory board. We have some top thought leaders in affordable housing on our board, and really, focused in on some of these resident services. We got, Prudential Impact Investments as sort of one of our big institutional investors. But I'll tell you, the American institutional investors, I find them quite schizophrenic on the issue of social impact right now. A lot of them are talking about it. Very few of them are doing it. You actually I find certainly program managers who are very interested in it and investment managers who are scared to death of doing something that's outside of the norm. That may be changing a little bit. We've recently partnered with Capricorn Investment Group, which is explicitly their institutional money manager, and they focus on impact. And they're saying what you're saying, Peter, which is that the European investors are much further along on this. And we have our focus on a lot of the ESG aspects, and we're talking about doing a European fundraising tour in the fall, because I think from everything we're seeing is that the Europeans are interested in the US because they like US-based real estate. If we can do that with ESG, which we do, we may have more traction on the ESG message in Europe than we actually do at home.
I think that's right. I think you'll have more traction, and there is a lot of European money that's looking at the UK, can't get scale, and it's a springboard over to the States. And Asian money, from what we're seeing, is beginning to wake up to it as well. And I would say it's not all one way. The American money that is here, the Blackstones, Goldmans of this world, it's important to them here as well, because our market, your exit 5, 10, 20 years time is going to be driven by all of that. So it feels like it's a trend that's going to spread.
One more question, Peter.
Yeah, that's really interesting.
Sorry, Jordan.
Please.
Sorry, Matt.
Go ahead.
No, you go.
Oh, okay. I was just going to comment that I'm still learning about ESG, but my understanding is that there's a tremendous amount of capital that's earmarked, especially since March 2020, directed towards ESG investments. And so it's interesting to hear your experience, Dan, and how it's been deployed. I think there's a tremendous need for it. We're looking at opportunities to improve our offering. And kind of an interesting case study on that respect was, we have our communities certified as Energy Star, energy efficient homes. And, to me, I think that's important, not only on the development construction side, but also on the long-term operating side as a benefit to the renter and the owner. But interestingly, we really haven't seen tremendous consumer response, where, it's kind of oh, that's nice. And they kind of move on with the rest of their decision-making process. So I think in the American front anyways, there's probably, early stages anyways, or not as strong of a market demand for ESG principles in their home.
And Matt, did you have to pay a premium on your construction cost to get this Energy Star qualification? And if you're saying that the tenants were not super responsive to it, did you get a premium on the rent too? And the next question is,
yeah, I haven't seen a premium on the rent.
Sorry,
I didn't mean to. Go ahead, keep going.
No, yeah, and I was finishing with Peter to ask him on the investor side, are the ESG investors willing to sacrifice some of the returns to be ESG qualified? But Matt,
yeah, great question. Sorry to jump ahead there, but yeah, I was able to do it with very minimal marginal cost. It's really about designing it well. But Energy Star is kind of like the lowest common denominator of taking the first step towards being energy efficient or having any sort of green mark on your community or product. So, it's sort of elementary, but yeah, I was able to get that done. And we're looking to continue that and continue to grow on that at Harvard. But, as far as the returns go, we think we have a better product long-term. And so, that as a firm that looks to hold the real estate, we're building for ownership, and we're happy to have a better quality construction product.
Yeah, I'm Dan and Matthew. I'm very happy to hear about that. It's not something that we've put a whole lot of thought into. Probably we should be, but I think we should definitely connect offline, because there's a great need in our industry, and I mean the build for rent space, to develop some standards, and perhaps there's an opportunity there for all of us to collaborate as a group. I don't know, Marina, how we're doing on time. Should we open it up for questions or?
Definitely, if people want to submit any questions, please feel free to go ahead. That would be wonderful. Other than that, you know, as soon as the questions come in, if any come in, feel free. I think we have 15 more minutes, so we're good on time.
Okay, great. So if it's okay, while the questions come in, I know that they're piling in by the dozens every minute here. Peter, I'm really curious about one thing. We talked a little bit about this prior to the panel starting. So, and you may not have the answer to this, I apologize, but so pan-European, looking at the build-for-rent space, how large is that market, and what is the average square footage of a typical build-for-rent unit that's being designed across different markets? I'd be really curious to learn about that.
Oh, lots of questions. So unpacking that slightly, what is the size of the market? So in the UK, the build-to-rent trading market is 3 to 5 billion pounds. We think it's going to ultimately, we think that the UK is going to catch up with the States, and it's going to be an allocation of between 20 and 25% of all institutional capital is going to be in residential. It's currently 5%, so it's a long way to go. The institutionalization of residential in Europe is much bigger. There are some very, very large players in Europe, the likes of Heimstaden. You know, 5 years ago, they had 5,000 units. They've now got 120,000 units under management. And that's just a growth policy. Dan, a lot of that is key worker. We call it key work. I think you call workforce, key worker housing. So small A affordable, because we have a regulated residential business here called affordable. So they're growing really quickly. The larger institutions own, you know, in that sort of order, 50 to 300,000 units. So nothing like you guys in terms of scale. And I think the question is about how big is a unit. I think there's how long is that piece of string.
Yes.
You know, but for a housing product, to make it efficient against for sale product, our units are much smaller than yours. You know, they're under 1,000 square feet. For 2 or 3 bedroom houses, maybe you could squeeze a 4th in there. They are quite small because the market is very competitive. If we get that rental growth, you know, if you're renting something at £17 a foot per annum, there's not a lot of space in there to compete against a for sale product. But I think that when all of this happens, that you're all talking about now, the product is becoming more fit for purpose. You know, at the moment, we're just buying houses that are built by somebody else, but when they're purpose built, I think that naturally the units are going to be bigger, they're going to be more amenitized, and you know, the unit, I mean, they're not going to be big as the States, but you know, maybe 1,000 plus for a 2 or 3 bedroom home. Little garden, little driveway. Does that answer the question?
Yes, it answers my 20 questions packed in one. I appreciate it. I think as a concluding point, there's a few questions that I see starting to pop up. I think it's really interesting to note that because of all of the capital that's flowing into the space, I do believe that there's going to be quite a bit of consolidation, you know, coming into next year. I also think that unfortunately there's going to be many build-for-rent projects specifically that will not, you know, fully make it through because now there's a lot of, you know, irrational exuberance, if you will, as it relates to how to capitalize these deals. And so I think that there's going to be a lot of consolidation opportunity on that front as well. And I think it would behoove all of us on this panel to keep our ears peeled and see how we can join forces and be strategic in that regard. So with that said, the one question that I saw here was, are there any successful fractional equity ownership programs that we've seen that work, similar to the program, Dan, that you mentioned earlier? I personally, I'll start and feel free to chime in, guys. I personally have seen many different models, mostly coming out of the prop tech sector, for fractional ownership. My personal opinion is that anytime that we have tried, and most of our leases are 2 years, anytime that we have tried or even offered a rent to own type scenario, or even a fraction of your rent after the first year goes into a deposit structure for home ownership, I have not seen a big take on that offer. And I think a lot of it has to do with the fact that we live in the kind of optionality economy where, you know, you can rent with me for 2 years and you may move to another market and rent with somebody else. And so why should I take that offer? But you know, to the panel, please feel free to comment.
I'm not aware of programs that are wildly successful, but I am aware of programs that are starting and they seem to be proving out. It seems to me that there's activity in the lease to own arena, where you have single family rental firms offering a rent to own program, and on the other side of the spectrum, you have vacation rental concepts that are offering fractional ownership in vacation rentals. They seem to be gaining traction and growing. I'm not inside the building, so I don't know what their economics look like, but there's hope for them. I do think, taking a step back, there's a tremendous need to think about how do we continue to capitalize the need for additional housing, and how do we have inclusive capitalization, along the lines of how Dan's been approaching it, but maybe even broader outside of the most sensitive or sensitive populations. And there was an interesting study by ULI Terwilliger Center that came up with the idea of actually taking communities and turning a specific community into a REIT, so that residents in the community could own shares of the REIT, thus having a participation in their community. So, I think there's opportunities for us to continue to grow, and maybe this is a way to get past some of the constraints on delivering new supply, most notably NIMBYism, or not in my backyard, where neighbors don't want, everyone understands we need more homes, but they just don't want them next door. So here we are with the housing shortage, and maybe by offering ways to create more inclusive participation in new housing growth, there's opportunity there. But I mean, these are really complicated structures, and it's hard enough just to deliver a new construction home. So or to provide a scalable operation that delivers a quality rental home experience. So these are nice to haves, but really integrating them into day-to-day business for any firm is certainly a challenge.
And I could talk a little bit about it. Fractional ownership is a really broad topic that I think there are a lot of firms that approach it in very, very different ways, depending on who they think they're marketing towards. So you have, Matt mentioned some of these prop tech companies. Seems to me a lot of those are targeting, I don't know, the 20-somethings who are coming out of college and they have maybe good credit scores, but they don't have a lot of down payment and they want to get into a house. So they're doing things for them. You had a group like Home Partners of America that was actually looking at people who have a decent amount of money, maybe have some issues with their credit, and they would buy the house on behalf of that family, underwrite the family, and then with the goal of selling them the home. Our approach is very different. We're taking people who probably never thought they were going to buy a home, and we're trying to give them the tools to get there. Our program is small scale. I think it has a lot of traction. All these things, I think right now they're niche programs, all of them. And I think we're all trying to solve different parts of the equation, which is how do you address either credit score or lack of down payment or lack of financial literacy. And so there's a lot of, a myriad of ways of doing it. I think they're all early innings. It's interesting. I'll just say there's another one, which is the community land trust model. I don't know if you guys do that in Europe, but here, it'll be a nonprofit that's set up. They own there's a house on a piece of land. The nonprofit will own the land, and they'll sell it to a homeowner. If the price of that house goes up, they can look at it and say, the house didn't change. It's really just the neighborhood getting better. So that's attributed to the land. So when the person goes to sell it, they come up with a formula. The homeowner gets a small piece of appreciation to help them sort of build a bit of a nest egg. That house then goes to another income qualified buyer at a below market price. And this is a way of anchoring some houses in perpetual affordability, which I think is a fascinating model. It's very new. It's reasonably new, and it hasn't gotten a ton of traction. I think it's gotten more interest in the last year or two from what I've seen. And I think that's one interesting trend to watch.
Yeah, we have shared ownership. So government would give you 10, 20, 30% of the money towards the property to reduce your risk as a punter, and very high mortgages. So it sounds similar to what you just described there, Dan, but it's a government-led initiative. And then we have lots and lots of for-profit and not-for-profit affordable housing providers who can dice and slice in so many different ways that it's a whole new topic, maybe for next time, Jordan.
I'm sorry, I was on mute. I apologize. Yeah, if iGlobal will have me next time, I'm more than happy to talk about that as well. Are there any other questions, Marina, that you'd like to bring forward? I'm sorry.
No, I think we're perfect. Do you think we're ready to wrap up?
Okay, excellent. From the on the panelist side, is there any other concluding points or closing comments?
Thank you.
So I'll throw a question out for the group. I think we got a couple more minutes, and then we can wrap up. I guess my question is, what's everybody's thought on new market entrants? Is there room for new market entrants to come in and scale? Is there room for 4 or 5 more Blackstone or Invitation Home stories? Just kind of curious, and how do you see that evolving?
I say, I'll just start if that's okay, Matthew. I say, come on in. Good luck. There's a big curve ahead of you. It's a very competitive market. Very competitive market. I think very much supply constrained for now, at least. But look, we're very blessed to live in the country that we do with as much land as we have. So I'm sure we haven't seen all the opportunities, and there will always be opportunity.
I think that there has been a lot of announcements recently of big players coming in and putting like big numbers on the table. I think there is a lot of work. They have a lot of work ahead of them, as Jordan said, before they can deploy a fraction of what they've announced. So I think there is time. It's time to bet, I think, on operators that have experience, that are nimble, that can act fast. Because the market is going to be more crowded, but it's going to take time for the big guys to be really up and running and efficient in their investment strategy.
I agree with that. I think there's plenty of space for everything that Thibaut's doing and Jordan's doing, and that we're doing, and you guys. If you look at all the operators today in the United States, I think we own collectively about 5% of the single family rentals. It is still hugely fragmented. So there's space.
Mm-hmm. Yeah. Good stuff. Well, thanks everyone.
Well, just from our side, 60 to 70% of all our trading is overseas capital. So we are always open for business.
Thank you so much, everyone. Okay, thank you. I think we're ready to wrap up. Thank you so much to all of the attendees for joining us today. And a huge thank you to the speakers for taking the time to provide us with such great information and industry content. Thank you again. A copy of this recording will be made available. You will receive an email with the link to download and save the recording. Again, we have several other live experiences scheduled for the next few weeks and months, and we encourage you all to join us for those as well. We're getting back to actually on-site events this fall. So we're gonna mix again, both webinars and on-site events. Again, thank you so much to our panel, and until next time, stay safe and healthy and have a great rest of your day from the whole iGlobal Forum team. Thank you.
Thank you.
Thank you all. Have a good day.
Thank you.